How's it going, everybody? My name is Warner Fields from Fields of Profit. Today I'm here with my friend Chris Potter, who's running about 43 tax firms right now in the e-commerce niche. Also exited an 8-figure Amazon business himself. We're super excited to break down the tax side of Amazon and just kind of get into the nitty-gritty a lot of people don't talk about. But if you want to kind of introduce yourself a little bit, Chris, maybe let them know how you started Amazon yourself way back in the day. We can kind of get into it from there.
Absolutely. I'm really glad to be back. I know it's been almost a year, I think, since I was on the video before, and lots of things have changed. Over the last year, we've grown significantly, helping out a lot of e-com businesses. And when I first started, if you did not watch that first video, when I first started Amazon, it was all the way back in 2008, and I started on eBay in 2005. So I was in the industry for a long time. I've done pretty much every business model you can think of when it comes to running an e-com business. I've done arbitrage, I've done wholesale, I've done private label, I've done drop shipping. You pretty much name it, I have the background on it. Exited that business in 2020, and then we bought a bunch of these tax offices located in North Carolina and Virginia. And then about a year and a half ago now, we started our e-com specific bookkeeping and tax business, which kind of combines the two. So, that's a very, very quick background on me.
Awesome. Yeah. So Chris is awesome, super successful entrepreneur. We're going to get into some of the tax questions a lot of people just simply aren't qualified to answer. So we're excited to have Chris on the channel here. So let's just go ahead and break it down, kind of start simpler, and then we'll get into some questions I got on Instagram. It's kind of the really nitty gritty. So for that seller, they're trying to get started on Amazon. I get the question all the time, how should I be setting things up right from the get-go? Do I need an LLC? How do you recommend that new sellers just kind of have the foundation laid as they kind of get their business going?
Yeah. So a lot of sellers, they actually just start out just selling stuff out of their basement or selling books, or they're not even really thinking about a business usually. And when you're in that scenario, you're already running the business. The moment you start selling something, you are running the business. It's just considered a sole proprietor, which is how most usually start out. Once you kind of realize, I think this thing's a little bit for real, and this is actually a real business, then you probably should start thinking about moving over to an LLC. The only time I really recommend to potentially not move over to an LLC is if you're located in California. And the reason for that is because in California, there is an $800 minimum franchise tax as soon as you open up that LLC. And every other state doesn't have that problem.
That's California does. That's way too high. That is insane.
It's silliness. It's straight silliness. And that's it. If you sell $0, they'll do nothing. They charge you $800. Just absolutely silliness. So, that's the only state that I would say that it's probably necessary to start out with an LLC. And realistically, from a tax perspective, it makes absolutely no difference whether you're a sole proprietor or moving over to an LLC. It's mostly just a legal liability aspect. And so that's kind of like just starting out. That's typically what we recommend. And then once you're at about $40,000 or $50,000 in profit for the year, then talk to your accountant about potentially moving over to an S Corp, which can save you on taxes.
Awesome. Yeah. So that was me a year or so into the Amazon journey. You talk to the accountant, it's hey, maybe this can save you on some taxes. It's really interesting. And that's why you need CPAs and people who are qualified. Is this super simple little thing can save you a bunch of tax money. So that's awesome. I know a lot of people are oh, I've got to wait for, all these formal contracts and LLC documents, all that kind of stuff to come in. Just get some cash flowing out of the basement. I like how you're putting it there, and then get it going from there. So beyond, sounds like you can wait a second to get the LLC set up. What else would you recommend they have as the foundation in terms of, tracking all their expenses as they come in? What have you seen a relatively inexpensive way for new sellers to track all that?
Absolutely. So I would say the biggest thing to start off with first, other than thinking about what your legal entity is creating a separate bank account for your business. That's by far the number one thing I would recommend to most new sellers. Is as soon as you get those first couple sales and you realize this is probably going to be a business, then you should open up a new bank account. And whether that's going to the bank and open up a business account, separate personal account, whatever you choose to set up, just set something up separately so that way it keeps your expenses separate. Also, if you're using a credit card, then your goal at this point should be to separate out your personal and business expenditures on two different cards. It is perfectly okay to run your business on a personal credit card. It's just not necessarily okay to throw your groceries at Aldi on the card and then, go to Louis Vuitton and spend a bunch of money. And then also, by the way, I'm going to stop at Kohl's and rack up Kohl's cash on all the same credit card. And the reason for that is if you ever were to get audited, it makes it more difficult to be able to say, oh yeah, this is all business stuff when you've got all these random expenses on there. They're obviously not business.
Yeah, for sure. You got the Lambo on there. You're Amazon seller day one. We all get Lambos, right? That's how it works.
Absolutely. I sold more than my black cards,
Awesome. Yeah. So that's something that I definitely waited too long to do. And it just makes things way easier after you do that, getting everything separated out. So separate bank account, getting all that kind of stuff set up. And right now we're kind of heading into the end of the year. Especially if you guys are watching this right after we just recorded it, coming into kind of the end of year tax prep season. So that's something we really wanted to kind of talk about. What are kind of the quick, bullet pointed things? We can kind of dive into it from there. What do people need to have prepped by the end of the year for their taxes?
Certainly. So year end, really a lot of this boils down to having accurate bookkeeping and preparing for taxes. Those are pretty much your big two things. So the question would be is like, what can I do before December 31st? Because we're releasing this video about maybe 2.5 weeks before the year ends. So there are still some things you should do prior to year end. There's also things you can do after the year ends to be prepared for taxes, which are generally due in either March or April, depending if you're an S Corp or if you're just a standard LLC or sole proprietor. And the various things you should do is number one, look at your bookkeeping. If you have no bookkeeping whatsoever, which is extremely common, I see a lot of new sellers that come
Yeah.
to us and they're like, I got nothing. They may have a spreadsheet, but that's kind of about the best we typically see. And so the first thing you should do is calculate all of your expenses in some fashion. Either do that in a software tool like Inventory Lab or SellerBoard. You can add those into either of those tools for Amazon sellers. That's one option. Keeping it in an Excel spreadsheet is kind of a secondary option as well. So keeping it somewhere is kind of step number one. Step number two is to actually have a connection between your bank accounts and credit card accounts with those transactions. And an Excel spreadsheet is usually your best way of doing this because Inventory Lab and SellerBoard don't have that connection at all. Like you can't actually put in there like this is on credit card blank and blank. Whereas on a spreadsheet, you can easily track all of that. We have put together a business tax worksheet, which is visible on our website at taloktax.com. Up at the top, you'll see that there's resource tab. And underneath that, you'll see that there is a business tax worksheet and you can download that directly. And we give that out to all of our clients, and anyone obviously isn't a client can download it too. And it outlines all the various categories you can write off for your taxes, and you can utilize your bank accounts and credit card accounts. Just export everything in CSV, pop it in there, and you have an expenses to keep track of it. Obviously, it's a little meaty there. Unfortunately, taxes is just a really dry topic. So
Right. It's not fun, but it keeps you out of the jail cell, I suppose. So that makes it important. So we'll get that link down below if you guys want to check out that spreadsheet. I'll pop that in the description for you. So yeah, that's awesome. So kind of just having all the bookkeeping in line, all that kind of stuff. Are there any kind of last minute deductions or anything like that you see sellers having success with? We were talking a little bit before about inventory. Or is there anything else you'd recommend people buy right before the end of the year just to kind of decrease their tax burden?
That's a good question. The other thing I didn't necessarily mention when I started that first little spiel a moment ago is the biggest thing you should do outside of just tracking your expenses, tracking your inventory, is making sure your inventory is right at the end of the year. And no matter what sort of tool you're using to track your cost of goods sold, even if you're using QuickBooks, Xero, or having a legitimate bookkeeper do your books for you, you should know at the end of the year, which is December 31st, exactly what your full scale inventory is. So we strongly recommend running a physical inventory evaluation at that point. And what that basic gist of it is you're just figuring out where all your stuff's at. There's some in Amazon, obviously, if you're running FBA. There's some possibly in transit to Amazon. There's some inventory possibly sitting in the prep center. There's probably inventory sitting in your garage. There's probably some sitting in your mouth if you're eating your candy you didn't sell for Halloween. There's all sorts of places that your inventory could be. And your goal is to figure out where all the inventory is at and come up with a proper valuation. Because when we're doing taxes at the end of the year, you need to know exactly what that valuation is. Not to mention, if you're doing proper bookkeeping, then it also gives you insight to how much inventory has been lost throughout the year, which can then be written off as an inventory shrinkage expense, which is one big issue we tend to see with sellers who are just using spreadsheets or just using Inventory Lab or SellerBoard, is they're almost always missing out on the inventory shrinkage aspect of it because none of those tools actually track any of it. So that's a big one.
That was a big kind of gap in our bookkeeping right before we started really tracking that. You really don't expect how many of these like big, massive retailers will be missing a unit here and all that kind of stuff. So at least if you're not going to get the inventory, you might as well, at least be able to write that off. So when you are kind of running those numbers at the end of the year, is it just as simple as I bought 100 of these over the course of the year? They only shipped me 99. You just writing off that one unit as shrinkage?
Yeah, you're calculating the entire total of what the number is, and then that's what we're writing off for that.
Awesome. Yeah. So on top of that, has there been any systems? You mentioned a lot of the tools don't track that kind of stuff. Are there any systems that you've seen sellers have or that you guys used in the past that kind of helped you track leakage a little bit better?
The biggest thing would be having a proper bookkeeping system. That's the first part, because that connects what you physically have purchased versus what is actually sold through Amazon. And those are the two main pieces you need to know. And once you know those two main pieces are, then it's a matter of figuring out how much you're actually off. And then once you know how much you're off, then you can start digging into saying, okay, well, why is it off? And the larger sellers have systems in place for literally everything. The largest sellers do. They'll have a system in place to track when items are received. They have a system track to say, okay, well, when it was received, where did it go from there? Did it actually get to Amazon? Did it get lost in transit to Amazon? Did it get lost in transit to the prep center? They have a system in place to validate all of this stuff. They also have a system in place to validate if there's duplicate charges on the credit card. There's also a system in place to verify if a wrong item was delivered, did it ever get returned and then actually refunded back to your credit card? And these are all systems that typically larger sellers will have almost a full-time person doing nothing but validating all of this stuff, because most of the time paying a full-time person in the Philippines costs significantly less, and all of that inventory that ends up getting lost you have to write off at the end of the year.
Yeah, our admin VA, that's probably at least half of her job is just like, hey, we ordered 25 of these and we only got 23, and all those little things like that. Like, even for you guys who aren't massive scale, make sure you're at least tracking the difference between what you shipped to your house and what shipped out of your house. Like, there's going to be stuff beyond that, but like that's the biggest one that I noticed was from the retailers to you, at least from my experience, tended to be kind of the biggest. I don't know, would you agree with that as well? Kind of supplier to you is the bigger one?
That definitely is the bigger one,
Yeah.
especially for OA clients. That by far
Right.
is the biggest issue. Obviously, when you're going to wholesale, private label, it's not as much of a problem. It's mostly what happens at Amazon and prep centers becomes more of the issue. And then prep centers, of course, those are kind of a black box if you're not using a prep center that actually does true tracking inside their warehouse. As we've seen stuff get disappeared and lost and who knows what. And then you have to figure out who actually pays for the problem. Is it the prep center? Is it the company that sent it? You know,
Right.
they got all that whole deal to deal with too.
Yeah, a lot of times that'll be like in the prep center documentation and all that, but it's always a headache you ideally want to avoid. So we were kind of touching on this a little bit, but a lot of people at the end, they get to the end of the year and it's like, oh, I made $50,000. Let me just buy $50,000 worth of inventory. Can you talk a little bit about cash versus accrual and like kind of how that decision making process works with inventory?
Absolutely. So well, we do get this question a lot is like,
Yeah.
maybe I should just like buy a bunch of inventory and not pay any taxes this year. That only truly works if you're on the cash method of accounting. So the difference between the two on cash versus accrual, if you've never heard this before, and we're just looking at this mostly from a inventory perspective. For cash method, it means that the moment you buy something, it's just immediately written off. With accrual method, it means when you buy it, it's considered an asset to your company. And then when you sell it, it moves from asset to an actual expense that gets written off on your taxes. So the difference here is that's either when you buy it or when you sell it. And so if you're on cash method, it allows you to immediately write those off like at the end of the year, just like you mentioned. I can go buy, $100,000 worth of stuff right here at the end of December and boom, it's a tax write-off. And I'm good to go going into next year. I can pretty much write off my entire income for the entire year because I bought more inventory. And so that's kind of what we tend to see with a lot of people who are doing cash method. With accrual, it's a little different because you can't necessarily do that. So that's part of the challenge. But you did ask like, what are some things you should do at the end of the year? I mean, that's obviously option number one is to buy more inventory if you're on cash. Now, if you're just starting out, then when you talk to your accountant, you're going to have an option to move between either cash or accrual. And then once you choose that method, it sticks with you basically for all years moving forward. There's a way to change it back, but it's very painful. So it's
Sure,
usually
yeah.
once you pick a method, you stick with it. And if this is your first year, I would strongly recommend discussing with your accountant their thought process behind on which option you should choose. Most accountants will almost always say use cash because it saves you most amount of money that first year when you're in business. However, one thing that they probably won't tell you is you have to look at this not only from a tax perspective, you have to look at this from a business owner's perspective as well. Because if you look at it from a business owner's perspective, all right, let's say for example, 2 years down the road, I'm like, I want to get some loans for my business because I really want to like blow this thing up. Well, your options are typically Amazon loans are usually the first place people usually go, but the interest rates are pretty high in Amazon loans. Same thing with Marcus loans, they're pretty high. The best loan you usually can get are through local banks or through major banks and lines of credit through those same institutions. When you go to try to do this, they almost always will ask for 2 years worth of tax returns. And if you decide to use cash that first method or even the first year and even that second year, you almost positively are going to show negative profit. So think about it. Like, is there a chance that someone's going to get approved for a loan if your first 2 years in business you lost money? Probably not.
Probably not. It's probably a hard sell at that point, right?
Exactly.
Yeah.
Exactly. So that's kind of one of those things where like you have to think through like, okay, if I'm going to write everything off this year, like that's an issue. And then there's also a reality of the fact that usually when you're at about a 2 or 3 year time span, you're either going to likely sell your business or be out of business or slow down your inventory in some fashion. Now, there's a percentage of people that this isn't true and they totally blow it up and they're doing very well. But let's be honest, we're all business owners. We know showed that on average, most business owners don't stay in business longer than 3 years, which is it's a sad fact, but it's true.
I mean, it's hard. It's not for everyone.
Mhm.
Like it takes, yeah, it's a lot of effort, a lot of
Yep.
sacrifice, but it makes sense. It makes total sense.
Yep. And so with the cash method, like we're just talking about, you get that sweet, sweet tax write off this year. You get that sweet tax write off in the second year. And then the third year, you're like, oh crap, I'm going out of business. Molly, what do you think's going to happen? All that money you made over the previous 2 years gets all shifted into that final year. And so now when you're getting ready to go out of business, when you have no money, that's probably why you're going out of business. Now the IRS is going to say, time for you to pay up.
Yeah.
And so that's our thought process I always want people to think about when they're trying to make that decision on whether they want to go cash or accrual. It's not as simple as thinking this year can I save as much in taxes. It's like looking at it from a multi-year perspective and what your goals are moving forward. And if there's also other scenarios where it makes sense. Like if you have a very high W-2 job that you currently have, and there's various scenarios. And realistically, your accountant should be able to ask these questions and have that conversation with you. And if they immediately just say do cash because you're going to save as much money as taxes this year, they're not thinking through it as a business owner. They're just thinking through what can they save you on taxes this year, which is how a lot of accountants think. So just keep that in mind.
Yeah. Yeah. That's awesome. I didn't even think about it from the terms of like a couple years from now. Hopefully you've made your money, you want to get out, that kind of thing. But it makes total sense that the accountant would be like prioritizing everything they can to save you money. It makes them look better. So it's an interesting mix of incentives there. So another thing, and this was one of the really good questions I got through kind of an Instagram poll I put out. How should sellers, hopefully they're paying themselves a little bit of money, right? Obviously you want to be reinvesting a lot and continuing to grow. How should sellers be paying themselves, even if, they're not a formal company, that kind of thing? Like, how do you see people structure that?
Well, you just pull money out and you just wave it up in the air. That's what most people usually do, right?
And then you put it on the Lambo.
Absolutely, absolutely.
Yeah,
Obviously, we know how all the dropship gurus do it, right? That's what they do.
exactly.
They just go to the ATM machine, just pull it out.
Yep.
And then they create a couple of videos to make it look like they got even more. That's usually what they do. Now, what a real business owner does is it depends on what style of business you are. If you're starting out and you're a sole proprietor or you're an LLC, then all you're doing is literally just doing a transfer from your business account to your personal account. That's it. It could be a Zelle. It could be an actual literal transfer between banks. It could be you physically removing a cashier's check and taking it to the other bank and do that, which, I'm really dating myself by saying that. But, you can do all these various options. You can do a Venmo if you want, pull it from one, pull it to the other. You can do all these options. It's perfectly fine. And keep in mind that when you do this for tax purposes, it doesn't matter. It makes no difference whatsoever if you pull that money out when you're an LLC or a sole proprietor. It's just money you take out of the business and that's it. There's no tax implications though. With an S corp, it's a little bit different. Typically, you will be on payroll, so you'll have a actual paycheck that's coming in on a regular basis. Then, if you do want to take out more money outside of the payroll, then you would just again do the same thing that we're talking about with an LLC or a sole proprietor.
Right. Cool. That's something that, putting yourself on your own company paycheck is always a funny one. You quit the job so that you can grow a business to the point that you're back on the paycheck, but at least it's signed by you at that point. So when do you think is a good time for people to start paying themselves in general as well?
First day, right?
I mean, sometimes like,
I guess. So, realistically, there's a couple steps you should take before you decide to take money out of the business. And as a general rule, I would say that anywhere between 6 to 12 months is probably a pretty good time span before you really should start taking money out. But a few good steps to kind of look at is number one, you should take a look and make sure that you don't have way too much debt on your business before you make this decision. And what I mean way too much debt is if you take all of your assets, which is like all your cash, all of your inventory, all of your money that's sitting in Amazon, you add it up, then you deduct all of your liabilities, which would be how much you got sitting in credit cards, how much you have sitting in any loans you have out. And if that number is negative or barely break even, you absolutely shouldn't do it. So that's number one to look at. That means that you have negative equity. And we've seen some sellers that have this problem. And that by far is not going to work long term if you try doing it. Your business is basically worth nothing in negative money. Which is not good. So that's number one. Number two, I would strongly recommend having some sort of personal savings account before you make a decision to just fully move over full time. Because what you have to realize is that when you're going full time, what's happening is your paycheck fully disappearing. So now you have to rely on taking money out of your business to make this work. And if you've never been through this before as a business owner, money doesn't just like go straight line up usually. It's usually like up, down, up, down, up, down. And there could be months where you're killing it and you can easily take money out of the business. And there's other months that you're not going to be killing it. And it might even be difficult for you to take a dime out of the business. So you have to be able to weather those sort of highs and lows. And so having some sort of emergency fund is highly important, and keeping it separate from business, because the moment you stop paying yourself, it becomes really real. It really becomes
Right.
real. And that's a really big thing you should have. 6 months is ideal. More than that's even better, but 6 months is probably pretty ideal. Now, number three is what I would suggest doing is start doing a test, right? Before you even decide to quit, start taking money out of the business as if how much money you would need, as if you were going to work out of the business. So
Yeah,
if
I like
you,
that.
yep.
Yeah.
So if you need like 3 grand a month to live off of, just start taking 3 grand out of the business per month. Even if you don't need to take it out, do it to see how your business operates without that $3,000. If it continues to operate okay and you don't see any cash flow issues, then maybe you're set and ready to roll. If you
Mhm.
realize, oh crap, I'm out of money, I can't even pay my credit card bill, then there's no way you are ready to start doing this full time. So that's kind of one way. And the cool thing about this is you start doing this where if you pull that money out, you can just pad your savings account. You start padding your emergency savings account. So some people, you might say, all right, well, I'll just do this for 6 months, pad my savings account. And when I know I can do this for 6 months, boom, I'm golden.
Yeah, I mean, that seems like a major win right there. And a lot of people, they'll say like, oh, I can't do this with a 9 to 5 and that kind of thing. Like, it's awesome to see the amount of people that are like 100K, 200K plus a month with a 9 to 5. So if you're watching this and that sounds unachievable, like plenty of people doing it. I've talked to people on the channel, like you guys can do it. It takes some serious work. Like it takes some elbow grease, all that kind of stuff. But don't you guys think that sounds, super impossible? But I love that breakdown though. It's kind of like, can my business afford this? You pad the savings, stash it away and, S&P or something safe and all that, and kind of off to
Yep.
the
Yeah.
races from there.
What's interesting is you just mentioned that. Like, I literally talked to a guy, I think 2 days ago, where he's going to do a little over $300,000 this month, and he still has a W-2 job. He still has a full
That's
time
awesome.
job.
Yeah, that's
Craziness,
awesome.
craziness. And I was talking to another person as well. He has a full time job as well, but he's just doing books, and he only is making like 20 grand a month.
Yeah.
It's a matter of like what's good for you. And in one instance, he's trying to quit his full time job. In the other instance, he's like, you know what, this is just a side gig, just to kind of make some extra bucks. And that's why Amazon's great. Amazon's great because it can do both of those things.
Yeah, I also kind of want to add something to the paying yourself conversation. And obviously pending your step one where you're actually profitable and making money, that kind of thing. Something that I like to tell people is to pay yourself like 1% of what you made every month. Say you're making $300, it pays for a coffee, right? It just makes things feel real. So like I like that idea. Like, is that a smart idea as from the tax side? Like to me, it makes the money feel real, makes you drive a little bit harder. Do you think that's a smart idea for people?
I think so because I wouldn't say from a financial perspective it makes no logical sense,
Right. Yeah.
but
Yeah.
from a human perspective, like when you're running this business on the side, you're thinking to yourself, well, I can wait till later. But the reality is we're all human. We really want that like win. We want to have that win. We want to know what we're doing this for. And if you're never able to take any money out or do anything, then you're just working for what? And so
It's
I
just
really like the idea that all you're doing is pulling a little bit out here and there. So at least you're like giving yourself some rewards for doing it. Maybe you just do this, like, maybe you hit targets and goals for yourself. And you say, you know what, if I hit these targets and goals, then I will buy myself X, which might be that 1% number you're talking about. But do enough to where it's like not going to hurt you, but it also gives you that little bit of reward to hit that goal, which then keeps you moving forward. I
Yeah,
like
it's
that.
it's the coffee budget. It's the you get to go eat a meal out once a month, and then as you grow, it's like, oh, I'm buying an Xbox this month with my little chunk that I took, and like I like kind of just dangling the carrot for yourself a little bit.
Start on McDonald's, right? Start on
Right.
McDonald's, then work your way up to Chili's, and then maybe you'll end up a cheesecake factory.
I think that's the pinnacle, like the nicest restaurants in America. I want to say, right? It's like that's the order.
Maybe you'll stop
Awesome.
at the steakhouse every so often. Maybe Ruth Chris might go once you finally decide to
Right.
quit the
Right.
McDonald's.
For sure. So I want to make sure people are super prepared for end of years. A couple other things I want to ask you about as well. As far as coming up to your accountant at the end of the year, documents wise, what should they have prepped, like P&L, that kind of stuff? What are the simple documents they need to have ready?
Yep. So the key thing to keep in mind is it really depends on the accountant you're using. If the accountant you're using is unfamiliar with Amazon, then more likely what they'll say is, give me the stuff that you have. That will be what they'll say. And you'll be like, well, I guess I'll give you what I have, not really knowing what you have. And
Mhm.
they're just going based off the information that you're handing them, which may or may not be accurate. If you're working with someone who really knows e-commerce, they will tell you exactly what you need. And that's another kind of like gauge when you're trying to figure out who you want to work with this upcoming tax season, is that just ask them, that question and say, all right, well, what do I need for this? And if they're like, well, just give us a copy of your receipts and copy of your 1099 from Amazon. If that's all they
Mhm.
really ask you, like, they have no clue. So I just want to keep that in mind that like when you're kind of thinking through through how you're going to work this year. So now we have that. Talk about first. These are the things that you probably should need and have prepared for taxes, and the things that they probably should ask you for. Number one is if you're utilizing Inventory Lab or Seller Board or some sort of software solution like that, the person that's doing your taxes will likely ask you for access to that if they understand what they're doing. That's something we do. We ask for access to that, and we will pull out cost of goods sold data on there. We'll also pull out some of the other Amazon fees and expenses off of those tools, just as a comparison point to make sure that this other stuff you're giving us actually makes sense. And so the role of a tax preparer at this point is mostly to take like the pieces of information you're giving them and making sure it looks correct, especially if you have no full-scale bookkeeping solution, which is a majority of sellers who are starting out just don't have it. So if you're just starting out, like, it's even more important to work with someone who knows it, because realistically you don't know. And if the other person doesn't know, it's like the blind leading the blind at that point. So they'll ask for those. Generally, you'll need your 1099 from all your selling platforms. And one note on this is there is a change again this year. I know there was supposed to be a change where it's $600 sales on a platform. It was supposed to be. And that was actually supposed to be 2 years ago that's supposed to happen. And they delayed it on December 23rd last year.
Who knows if it's actually going to happen at this point? It's like, it's such an annoying rule to enforce anyway.
There's lobbyists pushing it back. And so they pushed it back again this year, which also means that moving into this next year, if you're under $20,000 in sales, you may not get a 1099, but that doesn't mean it's tax free. You still have to be able to show reports showing how much income you had off of those platforms. So if you're selling under 20 grand, then you'll likely need some sort of report from the selling platform to know what your sales were on that platform, so that we can know exactly what needs to be done. So there'll be some reports on Amazon that generally will need to get pulled. A date range report's usually something that should be asked for from Amazon. Then all of your various expenses. You'll need your expenses in some fashion. So that would be if you're using an Excel spreadsheet, if you're using some sort of other tool, keeping track of your expenses, all of that should be added up and prepared for your accountant to work on it. Then, of course, you have, like, if you have any mileage, if you've been doing any sort of retail arbitrage, or even just driving your OA packages to UPS store, you can write off all of that mileage. So you should have some sort of mileage log tracking all of this, and you should have that prepared for your tax person as well. Outside of that, it's mostly just any other documentation you would typically have if you're doing taxes. Like, if you have W-2s, we need that. If you have situations where if you have kids, sometimes you have various tax deductions that are associated with your kids and things like that. So all that stuff obviously too, but e-com specific, that should mostly cover it. But the biggest thing is you've got to know what your cost of goods sold are, and you've got to have your expenses prepared, and you have to have all of your ducks in a row, specifically with the Amazon reports and the selling platform reports.
Awesome. Yeah, the mileage one, especially if you're driving around to stores, can be really big. So don't underestimate that one. And if you're like me, I realized I wasn't tracking my miles my first year driving around getting books. And Google Maps will track your mileage. If you guys use Google Maps, you can go back and see, oh, I was driving to Goodwill. That was 10 miles and that kind of thing. Mm-hmm. So that's how I did it my first year. And then obviously you track a little bit better. You click this is a business trip. But if you guys are in a bind and you realize that, oh, I haven't been tracking that, maybe I should, you probably already have that data somewhere. So take that deduction. It's 58 cents a mile, right?
65.5 cents this year.
Higher. Awesome. Yeah. So that's significant for a lot of people who do retail arbitrage and all that kind of stuff. Cool. So another thing that really confused me as a newer seller, I'm sure a lot of people are kind of wondering about it as well, is when should people be paying quarterly versus yearly? Like, how does that break down?
Good question. So, if you're starting out your first year, more than likely you've paid nothing in taxes throughout the entire year. So what will happen is when we do your taxes, we'll figure out if you owe anything. And if you do, and you owe over $1,000, then more than likely you'll probably get hit with some sort of penalty from the IRS, because you're supposed to pay in if you're expected to pay more than $1,000 in a year. And if that does happen, it's common. It's something that, like, it sucks. You hear the word penalty, you're like, I don't like the word penalty. But
the penalty and taxes are like the two worst words combined with each other.
Absolutely. And realistically, in this instance, it's not that big of a deal. It's mostly just a small additional fund they'll charge you, which usually isn't that very high, and it doesn't really put you in any bad graces with the IRS. Some people think penalty, you're like, oh crap, now the guy's going to be knocking on my door. None of that's going to happen if this happens. So, pretty much you just pay whatever the penalty is if that happens to come up. And then your tax professional will more than likely say, all right, well, based on what you did last year, then you probably should be doing estimated payments going into next year. And, when they're working with us, it's just part of our tax process. We just do that as part of anyone that's working with us. We work that out, and then we tell you how much you probably should pay. Now, the issue is with e-commerce is that it's like so up and down. Like, next year you could be blowing it out of the water, and your estimations you made last year were like totally wrong because you blew it out of the water. And realistically, that's where you should have tax accountant on your side to chat with and just say, hey, here's what I'm doing. here's how we're going so far. And obviously, if you're using the same people to do bookkeeping and taxes, makes it really simple, because then you just send a message over to your accountant and just say, hey, what do you think I should do for estimated payments? And they can easily log in, look at it, and say, yeah, I would send X amount in. They can just tell you. Basic gist of it is that it's not like you're paying anything extra. You're just prepaying it. Now, there are a lot of sellers who just say, I don't even want to pay it. I'll just pay for it in April. And it's a logical response. And the reason why it's logical is because generally the penalty is like 8%. It's an annual fee of 8%. And if you think out from a loan perspective,
Sounds like a cheap loan. Yeah.
Exactly.
Yeah.
That is exactly how a lot of sellers think, especially like larger sellers who know that if they just hold on to that money during Q4, they can, like, if you pay like $20,000 in taxes, you can turn that 20 grand probably into 30 grand,
Right.
And so it doesn't make a lot of sense to prepay that money to the IRS when you can use that money to make more money and then just pay the penalty, which is less than what you made in Q4. And so that's kind of like from when you look at it from a business perspective, that's kind of a way you can look at it from that way. But again, it's risky. It's very risky, because if you're going into Q4 and you're like, I'm going to blow this out of the water, then you buy a bunch of stuff, it tanks and you lose money. Now you have no money for taxes and you're broke. Okay, now you're screwed. you got to pay the penalty to do this. So you really have to think for it thoroughly and make sure that you're really good on your buying and make sure that you're good at what you're doing. And if you are, it's a pretty wise bet to go with that. But if you're a little more risk adverse and you're like, you know what, I want to make sure I don't have to deal with this, because the last thing I want is some telling me I owe them a ton of money and not allowing me to have any money on my paycheck, then definitely just talk to your accountant. They should be able to help you figure it out.
Awesome. Yeah. Yeah. So really appreciate you sharing tons of value with the audience. And obviously you do a lot of this accounting, that type of stuff for people. Can you kind of let us know kind of your 30, 60-second elevator pitch or whatever? Why should somebody watching this video come and work with you? Because I know we've had a lot of people find success, kind of working with you guys. Full disclosure, I'm not getting paid to make this video. I just think Chris does great work. And can you maybe let a new seller know what working with you would look like?
Yeah, I think I've alluded to some of the things in this video that you should be looking out for when you're looking to find someone. And realistically, we have a team of people who do bookkeeping, and we also do taxes. And even if you're not ready for bookkeeping, that's okay. We still can do your taxes this year. And some of the things that we do that are part of our tax services that a lot of other companies even charge you extra for are, throughout the year, we're here all year round, and we know e-commerce. So if you have tax questions throughout the year, you can shoot an email over to us and we'll give you our tax responses. Also, if you end up having to owe money to the IRS and you just have no money to pay them, we will actually work with the IRS to try and put together a payment plan for that, which we've seen a lot of people need that. So we will actually do that as well. Also, those estimated payments we talked about, will help get those set up. These are all things that other accounts will typically just charge extra for, or they won't even be around to do because they're only around during tax season. Not to mention, we just know e-commerce. We did a lot of e-commerce tax returns last year. On our franchise tax side of the business, we did about 11,000 tax returns last year. So we've done a lot of tax returns. We've seen every situation. We can help out not just e-com people. We can help out people that have rental properties. We can help out people that can have other businesses. We're not stuck just to e-commerce, but the majority of our people that do come to us from this side of the business is all. So hopefully that is, I don't know if that was 60 seconds or not, but.
No, that's perfect. Yeah. And I know you are doing, when this video comes out, I know you said you were doing some kind of a special. So can you let us know what that is and then where they can find you?
Yeah, I believe by the time you're watching this video, we should have our doors open for new clients for this upcoming tax season of 2023's taxes that we've done in 2024. And we're offering a special where you get a $250 discount with doing taxes with us this upcoming tax season if you sign up with us before January 3rd and make your estimated payment for doing the work with us. And the reason why we're doing it is not just to kind of push people to do it. It's because last year we realized that we just got swamped in February, March, and April because people didn't start thinking about taxes until February and March. And we just got annihilated. And it really hampered our ability to provide stellar service to certain people later in the year. So our whole goal is to kind of shift some of our clients up a little bit earlier this year. And so that's why we're doing it. It's not to try and squeeze people. We're just trying to save some people some money, help other clients, and have a better overall service.
Awesome. Yeah. So I'll drop the website down below for you guys. If you don't have a bookkeeper, you're looking at your books, it's like, oh man, I've got a war zone in here. I'm sure Chris can help you get sorted out there. So if they also want to reach out to you, I know you're a great follow on Twitter. So I'm sure they can ask you some questions there. Where can they find you?
Yep. Chris Potter 361 on Twitter is by far the best place to find me.
Awesome. Yeah. So we'll drop that down below as well. Really appreciate you hopping on the channel here, Chris, sharing some tax knowledge as always. The ugly topics that no one wants to talk about, but always super important. Make sure we're all staying out of jail as Amazon sellers. So appreciate you taking the time, Chris. Thank you guys for watching this video. Let us know if you have any questions, comments, drop those down below. Hit like, subscribe, that kind of stuff to help me out with the YouTube algorithm as well. But really appreciate you guys watching this video. Thanks again, Chris, and I will see you guys next time.